Look, I need to show you something that's happening right now in the precious metals market that most people aren't paying attention to. And I'm not talking about some theoretical future scenario. I'm talking about what's unfolding this week, this month, as we speak. The premiums on physical gold and silver are starting to move in a way that we haven't seen since early 2020. And if you understand what that means, you know that window of opportunity to acquire metal at reasonable prices is closing fast. Let me paint you a picture of what's actually happening on the ground level. I was talking to a dealer friend of mine yesterday, someone who's been in this business for over 30 years. He told me something that should make your ears perk up. He said that in the last 2 weeks, he's seen more institutional buyers coming in for physical delivery than he's seen in the previous 6 months combined. Not paper contracts, not ETF shares, physical metal that they want in their possession. Now, why does that matter? Because when institutions start moving into physical, they're not doing it on a whim. They have research teams. They have analysts who spend every waking hour studying market dynamics. And when they decide it's time to take delivery of actual metal, they're seeing something in the data that tells them the current pricing environment won't last. Here's what most people don't understand about how precious metals pricing actually works. There are two markets running simultaneously. There's the paper market, where futures contracts trade on the COMEX, where billions of dollars change hands every day based on contracts that represent gold and silver. And then there's the physical market, where actual metal changes hands, where someone takes a bar or a coin and puts it in a vault or a safe. These two markets usually track each other pretty closely. The premium, which is the amount you pay over the spot price to get physical metal, typically stays within a predictable range. For gold, you might see premiums of 2 to 5% over spot. For silver, maybe 3 to 8% depending on the product. But something's shifting. Right now, we're seeing premiums starting to creep up across the board. American gold eagles that were trading at 3% over spot a month ago are now at 5%. Silver eagles that were at $4 over spot are now pushing $6 to $7. And this is happening while the spot price has been relatively stable. What does that tell you? It tells you that demand for physical metal is outpacing supply at current price levels. It tells you that the people who actually want to hold the metal in their hands are willing to pay more to get it. And historically, when premiums start rising like this, it's a leading indicator of what's coming in the spot price itself. Let me take you back to March 2020. Remember what happened? The world shut down, markets went haywire, and something fascinating occurred in the precious metals market. The spot price of silver actually dropped initially, falling from around $18 to $12 an ounce. But here's the crazy part. You couldn't buy physical silver anywhere near that price. Dealers were charging $25, $30, even $35 an ounce for silver rounds and bars. Why? Because the paper market and the physical market completely disconnected. The futures traders were selling contracts, driving the paper price down. But nobody who actually owned physical silver was willing to sell at those prices. The people who understood what was happening, who saw the money printing that was about to commence, they held on to their metal. And the people who wanted to buy physical, they were willing to pay whatever it took to get it. Within 6 months, the spot price caught up. Silver went from $12 to nearly $30. The people who paid those high premiums in March, even at $25 or $30 an ounce, they still made money, because they understood that the premium spike was telling them something important about where the actual market was headed. Now, I'm not saying we're in an identical situation to March 2020, but I am saying that the pattern we're seeing right now, with premiums starting to expand while spot prices remain relatively contained, that's the same early warning signal we saw back then. And there are very specific reasons why this is happening right now. Let's talk about supply. The major mints around the world, the US Mint, the Royal Canadian Mint, the Perth Mint in Australia, they all operate on production schedules. They can only produce so many coins and bars per month, and right now, they're running at or near capacity. I was looking at the US Mint's production numbers for American Silver Eagles. In the first quarter of this year, they sold over 12 million ounces. That's a 40% increase compared to the same period last year. The demand is absolutely surging. And when demand surges but production capacity is fixed, what happens? Premiums rise. But it's not just retail demand driving this. Let's talk about what's happening at the institutional level, because this is where it gets really interesting. Central banks around the world have been net buyers of gold for 15 consecutive years. But the pace of buying has accelerated dramatically in the last 2 years. In 2022, central banks bought over 1,000 metric tons of gold. That was the highest level of annual purchases since 1967. And 2023, they bought another 1,000 metric tons. We're talking about countries like China, Russia, India, Turkey, Poland, Singapore. These aren't small players. These are major economies making strategic decisions about their reserve assets. And here's what's fascinating. A lot of this buying isn't being done through the traditional channels. China, for example, doesn't report all of its gold purchases in real time. Analysts estimate that China's actual gold reserves could be double or triple what they officially report. They're buying through back channels, through Hong Kong, through London, accumulating metal quietly without moving the market too much. Why would they do that? Because they understand something that most Western investors haven't fully grasped yet. The dollar-based financial system that has dominated global trade for the last 80 years is slowly being restructured. Not overnight, not in some dramatic collapse, but gradually, methodically, the world is moving toward a more multipolar monetary system. The BRICS nations, Brazil, Russia, India, China, South Africa, they've been talking for years about creating alternative payment systems, about settling trade in their own currencies rather than dollars. And just this year, they've made significant progress. Saudi Arabia, the cornerstone of the petrodollar system, has started accepting yuan for oil payments. The UAE has started settling trade with India in rupees. Every time a major trade relationship moves away from dollar settlement, it reduces global demand for dollars. And when demand for dollars decreases, countries need something else to hold as reserves. Gold becomes more attractive. It's no one's liability. It can't be printed. It can't be sanctioned. It's the ultimate neutral reserve asset. Now, I know what some of you might be thinking. You're thinking, okay, but I'm not a central bank. I'm not China or Russia. How does this affect me as an individual investor or someone trying to protect their retirement savings? Here's how it affects you. When central banks are buying gold aggressively, they're removing supply from the market. There's only so much gold mined every year, about 3,000 metric tons globally. When central banks are buying a third of annual production, that's a third that's not available for industrial use, for jewelry, for investment demand from individuals and institutions. And unlike other commodities, gold doesn't get consumed, it gets hoarded. When a central bank buys gold, that gold goes into a vault, and it stays there. It's not coming back onto the market. So every year, the above-ground supply that's available for trading gets a little bit tighter. Now let's talk about silver for a moment, because silver has its own unique dynamics that make the current situation even more compelling. Silver is both a monetary metal and an industrial metal. About half of all silver demand comes from industrial applications. Solar panels, electronics, electric vehicles, medical equipment. These are growing industries that require silver for their production. The solar industry alone is projected to consume over 200 million ounces of silver annually by 2027. That's up from about 130 million ounces today. Electric vehicles use about twice as much silver as traditional combustion engine vehicles. As EV adoption increases, silver demand from that sector is going to surge. But here's the problem. Silver mine production has been essentially flat for the last decade. We're producing about 850 million ounces per year from mining. Total supply, including recycling, is around 1 billion ounces. But total demand is already exceeding 1 billion ounces. The market has been in a deficit for the last 3 years. How is that possible? How can demand exceed supply without the price skyrocketing? Because the deficit is being filled by above-ground inventories, silver that was stored in vaults, silver that was held by investors and institutions, that silver has been coming onto the market to meet the demand. But those inventories are finite, and they're declining. The COMEX silver inventories, which are publicly reported, have dropped by over 30% in the last 2 years. The London vaults, which hold silver for the major ETFs, have seen outflows as well. At some point, and we don't know exactly when, but at some point those inventories get drawn down to a level where the market realizes there isn't enough readily available silver to meet demand. And when that realization hits, when the market shifts from there's plenty of silver to wait, we might actually run short. That's when prices can move very quickly. And this is where the premium situation becomes critical. Rising premiums on physical silver are telling you that the people who are closest to the actual metal, the dealers, the refiners, the mints, they're already seeing tightness in supply. They're already having to pay more to secure inventory, and they're passing those costs on to retail buyers. Quick aside here, because this is relevant for a lot of people watching. If you're sitting on $100,000 or more in retirement accounts, traditional IRAs or 401ks, there's a way to get physical gold and silver into those accounts without triggering taxes or penalties. It's called a gold IRA. I put together a free guide that explains exactly how it works, what the rules are, which custodians are reputable. It's in the description below. Worth checking out if you're thinking about diversifying your retirement savings into physical metals. All right, back to what's happening in the market right now. Let's talk about the COMEX for a minute, because understanding how the futures market works is crucial to understanding why premiums matter. The COMEX is where gold and silver futures contracts trade. These are standardized contracts that represent a specific amount of metal. A gold futures contract represents 100 ounces. A silver contract represents 5,000 ounces. Now, most of these contracts are traded by speculators who have no intention of ever taking delivery of physical metal. They're just betting on price movements. They buy a contract, the price goes up, they sell the contract, they make a profit. Or vice versa. It's paper trading. But some contracts do go to delivery. And this is where it gets interesting. When someone stands for delivery, meaning they actually want the physical metal, the short side of that contract has to deliver it. They have to provide the actual gold or silver. In recent months, we've seen an increase in the percentage of contracts going to delivery. More people are saying, I don't just want to trade the contract, I want the metal. And when that happens, it puts pressure on the physical supply. Because the people who sold those contracts short, they have to go out and find the metal to deliver. This is why some analysts talk about the possibility of a short squeeze in silver. If enough contract holders demand physical delivery, and if the shorts can't find enough metal to deliver, they'd have to buy it on the open market at whatever price they can get. That could drive prices up very rapidly. Now, I'm not predicting that's going to happen tomorrow or next week, but I am saying that the conditions for that kind of event are becoming more favorable. The inventories are lower. The demand for physical is higher. The premiums are rising. These are all signs that the physical market is getting tighter. Let's talk about what's happening with inflation, because that's obviously a major driver of precious metals demand. The official CPI numbers say inflation is around 3 to 4%. But if you actually go out and buy groceries, if you pay rent or a mortgage, if you pay for insurance or health care, you know that your cost of living has gone up a lot more than 3 or 4%. There are alternative inflation measures, like the one calculated by ShadowStats, that use the methodology the government used back in the 1980s, before they started making adjustments to the calculation. By that measure, real inflation is closer to 10 to 12%, and that feels a lot more accurate to most people's lived experience. When inflation is running hot, precious metals become more attractive because they maintain purchasing power. An ounce of gold today buys roughly the same amount of goods and services that an ounce of gold bought 50 years ago. The same can't be said for dollars. A dollar today buys a fraction of what a dollar bought in 1974. But here's what's really concerning. The government's response to inflation has been to raise interest rates. The Fed has taken rates from near 0 to over 5% in less than 2 years. That's the fastest rate hiking cycle in 40 years. And the stated goal is to slow down the economy, to reduce demand, to bring inflation back down to their 2% target. But there's a problem. The U.S. government is now carrying over $34 trillion in debt. And when interest rates go up, the cost of servicing that debt goes up dramatically. We're now spending over $1 trillion per year just on interest payments. That's more than we spend on defense. It's more than we spend on Medicare. At some point, and this is the concern that a lot of economists have, at some point the interest burden becomes unsustainable. And when that happens, the government has limited options. They can cut spending dramatically, which is politically very difficult. They can raise taxes significantly, which is also politically difficult and economically damaging. or they can print more money to service the debt, which brings inflation back. This is the trap that many countries have found themselves in throughout history. It's why Argentina has had multiple currency crises. It's why Turkey's lira has lost 90% of its value in the last decade. It's why Venezuela's currency became worthless. When governments get trapped by debt, they almost always choose to print money rather than default. And if that happens in the United States, if we enter a period where the Fed has to choose between letting the government default on its debt or printing money to cover the interest payments, precious metals are going to be one of the few assets that maintain value. Now, some people will say, but gold doesn't pay interest. Why would I hold gold when I can get 5% in a money market fund? And that's a fair question. But here's the thing. That 5% you're earning, it's nominal return. If inflation is running at 8 or 10%, you're actually losing purchasing power even while you're earning interest. Gold doesn't pay interest, but it also doesn't lose value to inflation. In fact, historically, gold has tended to appreciate during periods of high inflation. In the 1970s, when inflation was running at double digits, gold went from $35 an ounce to over $800. That's a 20-fold increase in a decade. I'm not predicting that kind of move is imminent. But I am saying that the conditions that drove gold higher in the 70s, high inflation, currency debasement, geopolitical instability, those conditions are present today in ways they haven't been for decades. Let's talk about what's happening in the banking system, because this is another factor that's driving demand for precious metals. Last year, we saw the failure of Silicon Valley Bank, Signature Bank, and First Republic Bank. These weren't small community banks. These were major institutions with hundreds of billions in assets. And the reason they failed is because they were holding long-term bonds that had lost value as interest rates rose. When depositors got nervous and started withdrawing money, the banks had to sell those bonds at a loss. And once the losses became public, more depositors withdrew money, creating a classic bank run. The Fed and the FDIC stepped in and guaranteed all deposits, even those above the FDIC insurance limit. They created a new lending facility to provide liquidity to banks. They essentially backstopped the entire banking system. But here's the question. What happens the next time there's a banking crisis? What happens when the Fed's balance sheet is already bloated from previous interventions? What happens when the government's debt is even higher than it is today? The answer is that they'll do whatever it takes to prevent a systemic collapse. They'll print more money, they'll expand the Fed's balance sheet further, they'll guarantee more deposits. Because the alternative, allowing major banks to fail and triggering a cascade of failures throughout the financial system, that's not politically acceptable. But every time they do this, every time they intervene to prevent a crisis, they're debasing the currency. They're increasing the money supply. They're reducing the purchasing power of every dollar in existence. And this is why smart money, institutional investors, family offices, high net worth individuals, they're allocating a portion of their portfolios to physical precious metals. Not as a speculation, not as a bet that gold is going to double next year, but as insurance against monetary instability. Now let's talk about China specifically, because what China is doing in the gold market is absolutely fascinating, and most people aren't paying attention to it. China is the world's largest gold producer. They mine about 370 metric tons per year. But here's the thing. None of that gold leaves China. It all stays within the country. China is also the world's largest gold importer. They import another 1,000 metric tons per year, mostly through Hong Kong and Shanghai. So they're producing 370 tons, importing 1,000 tons, and none of it is leaving the country. Where is it all going? Some of it is going into jewelry and industrial applications, but a significant portion is going into investment demand and central bank reserves. The Chinese government has been encouraging its citizens to buy gold for years. They've made it easy to buy gold through banks and vending machines. They've created a gold exchange in Shanghai that allows for physical settlement. Why would they do this? Because they understand that in a world where the dollar's dominance is declining, gold becomes more important as a reserve asset. They're preparing for a future where international trade is settled in multiple currencies, where gold plays a larger role in the monetary system. And it's not just China. Russia has been accumulating gold aggressively as well. After the sanctions imposed following the Ukraine conflict, Russia realized that holding dollar reserves made them vulnerable. Those reserves could be frozen or seized, so they've been converting dollar reserves into gold. Russia's gold reserves have increased from around 500 tons in 2010 to over 2,000 tons today. India is another major buyer. The Indian central bank has been adding to its gold reserves consistently. Indian citizens have always had a cultural affinity for gold, but now the government is backing that up with official purchases. What all of these countries understand is that gold is the ultimate form of money that can't be controlled by any single government. It can't be printed. It can't be sanctioned. It can't be frozen in a bank account. It's a bearer asset that you can hold in your possession. And this is why the premiums on physical metal matter so much right now. Because when you see premiums rising, it's telling you that the people who want to hold physical metal, who want that security and that independence from the banking system, they're willing to pay more to get it. Let me give you another historical example. In 2008, during the financial crisis, something similar happened. The spot price of gold actually dropped initially as the crisis unfolded. It went from around $1,000 an ounce in March 2008 to around $700 by October. But if you tried to buy physical gold during that period, you couldn't get it at spot price. Dealers were charging premiums of 10, 15, even 20%. Some products were completely unavailable. The U.S. Mint actually suspended sales of American Gold Eagles for a period because they couldn't keep up with demand. What was happening? The paper market was being driven by forced liquidations. Hedge funds and institutions that were facing margin calls were selling gold futures to raise cash. That drove the paper price down. But the people who understood what was really happening, who saw the money printing that was about to commence, they wanted physical metal, and they were willing to pay whatever it took to get it. By 2011, gold had gone from $700 to over $1,900. The people who paid those high premiums in 2008, even at $800 or $900 when spot was at $700, they still made enormous returns. Because they understood that the premium spike was a signal that the physical market was much tighter than the paper price suggested. Now, I want to be clear about something. I'm not telling you that gold is going to $1,900 or $2,000 or $3,000 by next year. I don't have a crystal ball. Nobody does. What I am telling you is that the signs we're seeing right now, the rising premiums, the central bank buying, the declining inventories, the geopolitical instability, the monetary policy challenges, these are all factors that historically have preceded significant moves higher in precious metals prices. And the window to acquire metal at current premiums is closing. Because once premiums really start to spike, once we get into a situation where dealers can't keep inventory on the shelves, where mints are running months behind on orders, where you're paying 20 or 30% over spot just to get your hands on metal, at that point, you've missed the opportunity to buy at reasonable prices. Let me talk about silver specifically for a moment because I think silver might actually have more upside potential than gold in the current environment. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is currently around 85 to 1. Historically, that ratio has averaged around 60 to 1, and there have been periods where it's been as low as 30 to 1. If silver were to revert to its historical average ratio with gold, and if gold stays at current prices, silver would need to go to around $45 an ounce. That's nearly double the current price. And if gold goes higher, which many analysts expect, silver could go even higher. But beyond the ratio, silver has that industrial demand component that gold doesn't have. The green energy transition, the electrification of vehicles, the expansion of 5G networks, all of these trends require silver. And that demand is growing while supply is constrained. There's also the fact that silver is more accessible to average investors. If you want to buy an ounce of gold, you're looking at over $2,000. That's a significant investment for many people. But an ounce of silver is around $25 to $30. You can start building a position in silver with a few $100s. And this is important because when the general public starts to wake up to what's happening, when inflation concerns become more widespread, when people start looking for ways to protect their purchasing power, silver is going to be the metal they turn to first because it's affordable. We saw this in 2020 and 2021. When silver started moving higher, retail demand exploded. People who had never bought precious metals before were suddenly trying to buy silver, and the supply couldn't keep up. Premiums went through the roof. Wait times for delivery stretched to months. Right now, premiums are elevated, but they're not crazy yet. You can still buy silver at reasonable premiums if you act now. But if we see another surge in retail demand like we saw in 2020, those premiums are going to spike again. And the people who waited, who thought they'd buy when prices were lower, they're going to find themselves paying much higher premiums just to get metal. Let me talk about one more factor that I think is really important. The younger generation, millennials and Gen Z, they're starting to lose faith in traditional financial assets. They've seen the stock market crash multiple times in their lifetimes. They've seen housing become unaffordable. They've seen their purchasing power eroded by inflation. And they're looking for alternatives. Some of them are buying Bitcoin and cryptocurrencies, but a growing number are also buying physical precious metals. They understand that gold and silver have been money for thousands of years. They understand that these metals can't be hacked or frozen or inflated away.